On Thursday, the price of crude oil crossed the $100 mark. It obviously didn't stay there. By Friday, the prices had sort of fallen back down to about $98 a barrel. But it ended the week up about 10%. And that was the first time this has happened since May of this year. In spring, the conflict between Israel, Iran, US ultimately choked off tanker traffic across the Strait of Hormuz. The International Energy Agency had called it one of the largest supply disruptions in history. OPEC production fell by more than 9 million barrels a day in a single month. Then in June, there was an interim ceasefire between the concerning parties, which ultimately brought the tankers back. Flows were recovering, prices were collapsing, and it had fallen down to nearly almost $72 a barrel by early July. So when we hear that oil has crossed $100 mark, you need to understand what is actually happening here. The market is kind of already pricing in the piece that was expected. Now it is unpricing it as we are sort of rising up in prices again. So let's get into this and understand what all of this means, why the prices have risen, and what can you expect for your portfolios, and what does it mean for the Indian economy as well. So why did oil prices rise? Well, over the past 2 weeks, fighting has escalated again. The United States Central Command has now carried out its 13th consecutive night of strikes at Iran. President Trump has warned severe retaliation if Tehran and Iran do not sort of back off, and if the Houthis continue to attack the ships in the Red Sea. Now, while all of those attacks have been happening, commercial vessels have also been hit. Tankers are also being targeted. Now, none of this has, as of yet, caused any significant physical shortage of oil. Oil is still moving, but the fear is that this could escalate very quickly, and then ultimately oil could sort of come to a halt again. Now, traders are calling this essentially a risk premium, which is also known as the extra amount that a buyer might be willing to pay to ensure that they have oil tomorrow. So it's essentially, think of it as an insurance against shortage. Now, ultimately, this isn't a supply-demand concern as of yet. It's more that the market is trying to price in if the war is going to happen or it's not, or what is the prediction that's going to happen around this. To understand why traders are reacting so violently, let's look at the map. There are two narrow stretches of water in this entire region. The first is the Strait of Hormuz, which is the exit from the Persian Gulf. Around 20 million barrels of oil a day passes through it. And that's roughly a quarter of all the oil that is traded by sea on Earth. And all of that is being squeezed through this tiny sort of gap, few miles long in width. Now, Saudi Arabia and UAE have all the pipelines that are bypassing the strait, so naturally they can carry on, but that's only about 2.5 million barrels a day, which is a fraction of what it is required from an oil consumption perspective globally. Now, the second choke point is newer to the story. It's the Red Sea. It's also known as the Bab al-Mandeb Strait, and it's towards the southern end. It's towards the approach to Suez Canal. And this is where the Houthis have been attacking, and they're concentrating their attacks more and more. For now, the US military has said that the Hormuz Strait remains open, ultimately with American and naval support. But shipping doesn't necessarily wait for a closure. There are war risk insurance premiums that are rising. Ultimately, transport costs, freight costs, all of those will sort of start increasing as well. And all of those costs will mean that the price of crude oil before a single cargo is actually logged could actually sort of start adding up. So why doesn't the OPEC simply pump more oil? Well, for decades, global energy security has relied on one assumption, that Saudi Arabia and its neighbors are holding millions of barrels of spare capacity a day. Now, that idle production could ultimately be switched on a crisis. But unfortunately, in this context, all of that spare capacity sits behind the Strait of Hormuz. So any emergency supply, any additional capacity that could be pumped out to make the oil markets calmer during the Gulf crisis can only be happening if we're able to reach that market, and that ultimately happens through sailing through the Strait of Hormuz. OPEC is also due to meet in the 2nd of August, and it's expected to sort of discuss raising September quotas by about 180,000 barrels a day. But when you look at the global consumption market, which is upwards of nearly 100 million barrels a day, it shows intent from OPEC side, but it ultimately won't stabilize the market if the Houthi sort of continue attacking oil reserves. So what does this mean if you don't trade oil for a living? Well, crude oil goes into the refinery. It comes out as petrol, diesel, jet fuel. It's used as feedstock for plastics, paint, synthetic fabrics, fertilizer, and many more things. The price sort of ripples outward in sort of roughly that order. You'll see fuel costs going up, then you sort of anything that's accommodating that uses fuel, so trucking, rail freight, airlines, deliveries, your local petrol pumps, etc., could also start increasing prices. And anything that's ultimately made from petrochemicals, those costs go up. And then finally, we get to the real meat of things, the food, the fertilizer. All of those are linked to oil as well. But the price at the oil pump is probably the one that doesn't necessarily track what is happening in the oil markets on a day-to-day basis. And there are three reasons for this. The first is there is a lag. These refineries, these distributors have to work through the inventory that they've already bought a couple of weeks ago. The second is that there's a large share of what you pay at the pump in the Indian context is also tax. And that tax doesn't necessarily move when oil prices are rising or falling, etc. Finally, if you are not paying in dollars, which is what Indians are doing here, the exchange rate ultimately matters quite a bit. Oil is priced in dollars. A weaker local currency, as is the case for India, can make crude much more expensive for you, even on a day-to-day basis when the global prices might be falling. Now, expensive energy ultimately behaves like a tax that nobody's really voted for. Energy is an input into almost everything, like we've discussed. So higher oil prices ultimately mean there will be an increase in prices across the board. And that's what inflation is. It's a sort of awkward kind of increase in prices that's driven by cost rather than people actually spending a lot more money. And central banks can't really fix this problem. You can't really raise interest rates for it because rising rates will mean that you're going to sort of squeeze the growth. Households can't have to spend their money, so they have to go out on fuel and any essentials, and they can't necessarily reduce that bucket too much. Businesses are absorbing these costs, which ultimately mean that there is thinner margins for them. So the pain is shared across the board, even if that pain is not necessarily being shared evenly. And countries that are importing oil, such as India, are sort of taking the hit. And any country that is exporting oil, such as the Middle East, are typically benefiting from the price rises as a windfall gain. Now, in the Indian context, we've already spoken about it quite a bit already. We are very economically dependent and exposed to the oil markets. We consume approximately 90% of the oil from importing it, and majority of that comes through water, through transportation, through the tankers that we've been discussing in the context of Strait of Hormuz, the Red Sea, etc. Roughly 40% of India's crude, 6% of the liquefied natural gas, and 90% of LPG, all of that comes to the Strait of Hormuz. If you look at the current financial year, in the first quarter, that's April, May, June of this year, India's crude or import bill came to nearly $50 billion, which is equal to nearly 40% of what we had spent in the last 1 year in total. Now, every $10 rise in the price of oil barrels adds somewhere roughly around $17 to $18 billion to India's annual import bill. And as the sort of gap widens, as the trade gap widens, that puts pressure on the rupee, which means your exchange rate gets worse. It also strains government finances. In the context of the government finances, RBI is expected to hold interest rates at about 5.25% for now, and it hasn't seen a serious sort of escalation or deterioration in their expectations on inflation, interest rates, etc. So they're waiting to see what's going to happen with this escalation. So where does this go? Well, there are three paths here for this sort of crisis to evolve into. The first is that there is a de-escalation. Talks resume, shipping sort of starts coming back to a normalcy. The risk premium that we had spoken about earlier, that sort of drains away, and oil prices go back to the $60, $70 per barrel mark. We know that's possible because that has already happened once this year, when in June prices had already fallen to about $78 a barrel. The second here is that there could be a long grinding standoff. There's no closure, there's no catastrophe, but there is this constant threat, there's this constant uncertainty of what's going to happen. And in the world, oil doesn't sort of spike to $200, unnaturally. It'll sort of have these uncomfortable volatile swings, which we'll sort of see in the headlines and the news all around the world. Now, for importing economies, as you can imagine, this will mean a much harder supply shock. Third is the real disruption, an actual interruption to the flows through Hormuz, the Red Sea, and that's where physical shortages will start appearing. Here is where spare capacity can't really reach the market, and the economic damage could be quite serious. Those are the three scenarios here. Right now, the likelihood is that we're probably sitting in scenario 1, maybe 2. The third one is currently out of the picture. However, the question is, how long will this sort of crisis stretch out to, and does anything actually stop moving in the context of the oil markets? Well, if you like this week's video, do drop us a like, share, and subscribe. Let us know what you want us to cover next. See you next week.